Good morning. At the outset, I will make the usual statement which I have. Thereafter, we will take any questions or observations, and we'll try and accommodate as many questions and observations as possible. So we'll proceed accordingly. The Monetary Policy Committee reviewed the macroeconomic developments and the outlook over the course of the past 2 days, that is 2nd and 3rd April, and in its meeting today, it voted by a 4:2 majority to reduce the policy repo rate by 25 basis points and to maintain a neutral stance of monetary policy by a 5:1 majority. I thank the MPC members for bringing to the discussions their experience and erudition. I also wish to express my appreciation for our teams in the Reserve Bank for their hard work in providing high-quality inputs for NPC's deliberations. I would now like to set out the main global and domestic developments that the MPC evaluated while formulating this decision. It noted that there is a further loss of pace in global economic activity since its last meeting in February 2019. Moreover, the slowdown appears to be synchronized across advanced economies and some major market economies as well. This assessment is also reflected in the monetary policy stances of their central banks, which have either eased or paused. Inflation remains low in major advanced and emerging economies, although crude oil prices have risen on production cuts by major producers and supply disruptions among some exporters. As regards financial markets, equity markets have generally rallied. Bond yields have eased in some advanced economies and they have slipped to negative territory. In currency markets, the US dollar has traded with an appreciating bias while emerging market currencies have softened. Turning to domestic developments, the MPC observed that the Central Statistics Office CSO has pegged India's real gross domestic product GDP growth at 7% for 2018-19, down from 7.2% in its first advance estimates. More recent high-frequency indicators point to manufacturing growth slowing down while investment demand is subdued. Credit flows into micro and small as well as medium industries remains muted, though they somewhat improved for large industries. Capacity utilization in the manufacturing sector is running above its long-term average. There is also some improvement in business sentiment. High-frequency indicators of services sector such as sales of commercial vehicles and freight traffic indicate moderation in activity. The MPC also noted that CPI inflation rose to 2.6% in February 2019 after 4 months of continuous decline. The upturn reflected an increase in prices of items excluding food and fuel and weaker momentum of deflation in the food group. Households' inflation expectations declined by 40 basis points each for the 3 months ahead and for 1 year ahead horizons. Manufacturing firms reported reduction in input price pressures. On India's external front, export growth remained weak in January and February 2019, while imports, especially non-oil gold imports, declined. The trade deficit narrowed in February 2019 to its lowest level in 17 months. Net FDI inflow were, however, strong, while foreign portfolio investors turned net buyers in domestic capital market in Q4 of 2018-19. India's foreign exchange reserves were at 412.9 billion on 31st March 2019. Taking into account these developments and looking ahead, the MPC revised the path of CPI inflation downwards to 2.4% in Q4 of 18-19, 2.9 to 3% in H1 of 19-20, and 3.5 to 3.8% in H2 of 19-20, with risks evenly balanced. GDP growth for 19-20 is projected at 7.2%, 6.8 to 7.1% in H1 of 19-20, and 7.3 to 7.4% in H2, with risks evenly balanced. Beyond the near term, the MPC assessed that the short-term outlook for food and fuel inflation remains benign, although there is some uncertainty around the prospects for the monsoon and seasonal reversals in the prices of some items. The outlook for oil prices continues to be hazy both on the upside and the downside. Inflation excluding food and fuel has remained elevated, but has shown some moderation compared to first half of 2018-19. Financial markets remain volatile. The fiscal situation at the general government level requires careful monitoring. Overall, the output gap remains negative, and therefore strengthening domestic growth impulses by spurring private investment assumes priority. To summarize, global growth is slowing down, and this is also reflected in 3 successive downward revisions made by the IMF in its projection of global growth for 2019. Domestic GDP growth is also estimated to slow in 2018-19, with high-frequency indicators suggesting slackening of urban and rural demand as well as investment activity. While bank credit is growing at 14.3%, it is not broad-based. Bank credit to micro and small industries, which are critical to employment and exports, was flat at 0.6%, and also credit to medium industries at 0.7%. Growth projections for 19-20 have accordingly been revised downwards from 7.4%, which we had projected earlier, to 7.2%. Retail inflation rose to 2.6% in February 19 from a low of 2% in January. However, the upturn has turned out to be 30 to 40 basis points lower than our projections made in the February policy. Accordingly, inflation projections have been recalibrated. As per our current projections, headline CPI inflation is projected at 3.8% in Q4 18-19. Against this backdrop, the MPC voted to reduce the policy rate by 25 basis points while maintaining a neutral stance. Going forward, the Reserve Bank will continue to watch the evolving macroeconomic situation and shall act in time and act decisively. With the inflation outlook remaining benign, the RBI will address the challenges to sustain growth of Indian economy while ensuring price stability on an enduring basis in pursuance of its mandate in the Reserve Bank of India Act. I would now like to address some developmental and regulatory policies which we have announced today. We have about 11 announcements. One, the liquidity coverage ratio, LCR. The first one relates to LCR, liquidity risk monitoring tools, and LCR disclosure standards. We have allowed an additional 2% of SLR to be reckoned as level 1 high quality liquid assets for the purpose of computing the LCR of banks. While this move will harmonize the liquidity requirements of banks with LCR, it will also immediately release additional liquidity for lending by the banks. It has also been decided to form a committee on development of housing finance securitization market. We are aware that well-functioning securitization markets can enable better management of credit and liquidity risks in the balance sheets of banks as well as non-bank mortgage originators, and in turn would help lower costs of mortgage finance in the economy. We have therefore decided to constitute a committee that will assess the state of housing finance securitization markets in India, study the best international practices as well as lessons learned from the global financial crisis, and propose measures to further develop these markets in India. 3. It has also been decided to set up a task force on development of secondary market for corporate loans. At present, the secondary market for corporate loans in India is dominated by transactions of banks in non-performing assets and is constrained by sparse information on pricing and recovery rates. Recognizing the benefits of an active secondary market in loans, the Reserve Bank will set up a task force to study the relevant aspects, including best international practices, and to propose measures for developing a thriving secondary market for corporate loans in India. The next point, that is item 4, relates to the issue of instructions on an external benchmark. As announced in the Statement on Development and Regulatory Policies of December 5, 2018, it was proposed that all new floating rate personal retail loans, housing, auto, etc., and floating rate loans to MSMEs extended by banks from 1st April 2019 shall be benchmarked to external benchmarks like the RBI repo rate or any other benchmark market interest rate published by the Financial Benchmark India Private Limited. Taking into account the feedback received during discussions held with the stakeholders and issues such as 1. Management of interest risk by banks from fixed interest rate linked liabilities against floating interest rate linked assets and related difficulties, and 2. The lead time required for IT system upgradation. It has been decided to hold further consultations with stakeholders and work out an effective mechanism for transmission of rates. In the meantime, we have taken several measures to enable better management of interest rate risk by banks, for instance by allowing non-residents to participate in the rupee interest rate swap market. Number 5 relates to countercyclical capital buffer. The framework on countercyclical capital buffer CCCB was put in place by Reserve Bank in terms of guidelines issued on February 5th, 2015, wherein it was advised that CCCB would be activated as and when the circumstances warranted, and that the decision would normally be pre-announced. Based on the review and empirical testing of CCCB indicators, it has been decided that it is not necessary to activate CCCB at this point of time. Item number 6 relates to permitting government security trading through International Central Securities Depositories, ICSDs. As a step in the continuing process of broadening the investor base for government securities, the Reserve Bank, in consultation with government and SEBI, shall open a separate channel for international investors by allowing them to invest through International Central Securities Depositories, ICSDs. 7 relates to licensing of non-banking finance companies, NBFCs, as authorized dealer category 2. Increasingly, a large segment of resident Indians are availing foreign exchange facilities for the purpose of overseas education, medical treatment abroad, business travel, and private visits, which are primarily non-trade current account transactions. And these are presently undertaken only through authorized dealers category 1, 2, 3, and full-fledged money changers. With a view to improve the ease of undertaking forex transactions by increasing the last mile touch points of regulated entities to sell foreign exchange for non-trade current account transactions, it has been decided that non-deposit taking systemically important non-banking finance companies, that is NBFCs, NDSI, in the category of investment and credit companies, will be made eligible to apply for grant of authorized dealer category 2 license. Detailed instructions in this regard shall be issued by end of April 2019. 8. Benchmarking India's payment systems. Benchmarking India's payment systems is necessary to gauge India's progress vis-a-vis payment systems and instruments in major countries and give further impetus to the planned efforts for deepening the digitization of payments. A report containing the findings of such an exercise will be placed on the RBI website by the end of May 2019. 9. Framework for harmonizing turnaround time for resolution of customer complaints and compensation. Currently, different payment systems have varied mechanisms for addressing customer grievances, and the time for resolving customer complaints are not uniform. In order to have a prompt and efficient complaint redress framework for all electronic payment systems, it is necessary to have harmonization of the response time for complaint management and for other payment transactions, such as reversal of failed transaction across various payment systems. To this end, the RBI proposes to come out with a framework on turnaround time for resolution of customer complaints and compensation framework across all authorized payment systems. 10. Convergence of priority sector lending guidelines for housing loans between scheduled commercial banks, regional rural banks, and small finance banks. The housing loan limits for eligibility under priority sector lending were revised during June 2018 for scheduled commercial banks, excluding regional rural banks and small finance banks. It has been decided to extend the revised limits to regional rural banks and small finance banks also to provide level playing field to these banks. 9. Extension of NBFC Ombudsman scheme to cover non-deposit taking non-banking finance companies. In pursuit of strengthening the grievance redressal mechanism for bank customers, the Reserve Bank will widen the existing NBFC Ombudsman scheme introduced in February 2018 to cover customers of non-deposit taking NBFCs registered with the RBI and having asset size of rupees 100 crore and above. There is one more point which I would like to add with reference to the Honorable Supreme Court order on the February 12 circular. As you are aware, Honorable Supreme Court has held the RBI circular dated February 12, 2018 on resolution of stressed assets as ultra vires. The court has held that RBI's directions under Section 35AA of the Banking Resolution Act 1949, which are in respect of debtors generally, would be ultra vires of that section. Thus, the order of the Supreme Court mandates RBI to exercise its powers under Section 35AA in respect of specific defaults by specific debtors. The powers of RBI, it must be added that the powers of RBI under Section 35AA and other sections of the Banking Regulation Act 1949 and are therefore not in doubt at all. So they are not under doubt. The court, basically the Honorable Supreme Court has said that the powers of RBI under Section 35AA have to be exercised in a particular manner, and the validity of the Section 35AA stands, and henceforth we have to comply with the directions of the Supreme Court in this regard and act accordingly. In the light of Honorable Supreme Court order, the Reserve Bank of India will take necessary steps, including issuance of a revised circular as may be necessary for expeditious and effective resolution of stressed assets. The RBI stands committed to maintain and enhance the momentum of resolution of stressed assets and adherence to credit discipline. Thank you.